Welcome back to Monkeynomics. Today's lesson is about retirement planning. We'll be talking about the process, the different tools available to you, and some guidelines to keep in mind. Note that some of the things I'll be talking about, such as 401ks and IRAs, are specifically related to the United States and the US tax code. There may be similar programs in your country if you live outside the United States, but be aware that some things may not apply or may apply differently if you live outside the US. So let's get started. The most frequently asked question about retirement planning is how much someone should save from their income towards retirement. The answer is 10% of your gross or 15% of your net, depending on which one you feel more comfortable working with. So let's say you make $2,000 a paycheck, but net $1,300 a paycheck after taxes and deductions such as paying for health insurance premiums. 10% of $2,000 is $200 a paycheck, and 15% of $1,300 is $195 a paycheck. So it works out to be the same amount, whichever you prefer and find easier is fine. Now, if you're still in the process of paying off debts, as we talked about in our previous video about debt management, don't worry about retirement savings at this time with one big exception. If and only if your employer provides a 401k with a match, you should always contribute up to the match, even if you're paying off debt. The reason is that the 401k match is free money. Let's say your employer matches up to 3%, or $60 a paycheck if you make $2,000 a paycheck. By contributing the $60, your employer matches $60, and the total equals $120 in your 401k. That's a guaranteed 100% return, so always contribute to get the match. If the employer doesn't offer a match, forget it, and just focus on paying off your debts. However, employers don't match higher than about 3 or 4%, and that's not much. You should be able to swing that even if you're currently getting out of debt. This is literally the only time I will tell you to invest before being debt-free. Only do this if your employer matches your contribution. Okay, I think I beat that dead horse enough, so let's move on to retirement plans. First, let's talk about the two things that aren't retirement plans. Social Security is not a retirement plan. The money taken out of your check and FICA taxes does not go into an account with your name on it. It's not your money, and a lot of people are misinformed regarding how Social Security works. Your FICA taxes equal about 7% of your gross income. Unlike the normal income tax, there is no progressive scale, so everyone pays 7% regardless of income. All that money that's collected is used to pay current benefits, meaning that in 2015, the money taken from your paycheck in 2015 will be used to pay retirement benefits to seniors in 2015. None of it is saved on your behalf, and it never has been that way. From the 1930s to about 2010, the Social Security Trust Fund did run surpluses, meaning that it took more money from FICA taxes than it needed to pay for current beneficiaries. That excess money was used to buy government bonds, and thus added to the general budget, which was immediately spent that year anyway. So no matter what, nothing was ever saved, and in fact this intergovernmental debt is off the books, and allowed the government to keep the budget deficits down until about 2010, when the baby boomers started retiring, and the program no longer ran surpluses. The Social Security Trust Fund is nothing but a bunch of IOUs from the government, where they pinky promise to tax future workers to pay for your benefits when you're a senior. However, in 2033, Social Security will no longer be able to pay current benefits based on projected income from FICA taxes. There will simply be too many people taking and not enough people making. At that point, the program will slowly die as benefits are cut to match revenues, or maybe the whole program will be reformed entirely. Who knows, but it's going to happen. Nobody wants to be the generation holding the bag, but if you were born in 1968 or later, it's going to be you. So another system similar to Social Security, wherein you have no control over your money or benefits, is a corporate or union pension. The 401k is slowly replacing these systems because they are very expensive to the company and difficult to renegotiate during negative economic cycles. So if there's one thing I can impress on you today, is that you should not trust your Social Security or pension benefits to be there for you when you retire. Social Security is going bankrupt, and pensions are one Chapter 11 bankruptcy away from being cut. The only money you keep is the money you control, and you have no control over Social Security or pension programs. If I'm wrong and Social Security and your pension are there when you retire, that's great. That's icing on the cake, and you'll just have a lot more money than you thought, and I'm sure you'll forgive me for it. However, if your Social Security and pension are not there for you when you need them, you'll need to fund your own retirement, or have what's known as a working retirement, which simply means you work until you die and never retire. So forget about your FICA taxes and pension contributions. You must invest an additional 10% of your gross or 15% of your net on top of these programs in order to fund your own retirement. So there are three general ways to save for your retirement, which include several variants within them. The first is the 401k, which is named after the section of the tax code that covers these plans. Other plans that function similarly to 401ks, but may be unique to specific industries, include the Thrift Savings Plan or TSP, 403b plans, and 457 plans. These are all employer-provided plans. The positives are that the employer may match your contributions up to a point, usually around 3%, and deducts the money pre-tax, which means that it will lower your taxable income and thus affects your net income less. The negatives for these plans is that you are very restricted regarding how you can invest the money. You are limited by whatever your employer set up, and employers tend to go with the options that cost the least amount of money for them and not necessarily what is going to accomplish your goals. Many of them use generic mutual funds, mostly index funds. These are fine while you're working at the employer because the employer match is giving you a 100% return. So even if the returns from the actual fund are subpar, that instant doubling of your money is worth it. However, once you separate from your employer, you want to get that money out of there and into something that you have more control over. If your employer doesn't provide a match, or if you're looking for something to put your 401k balance from a previous employer into, you will want to look at IRAs or individual retirement accounts. You can also roll your old 401k into your new employer's 401k if they'll allow it, but there's really no benefit to it, with the notable exception that corporately owned assets like 401ks are harder to garnish than individual assets like IRAs. However, you'll be debt-free and unmarried at this point anyway, so who cares? Whatever you do, don't cash out your old 401k when you leave your old company, because you'll not only have to pay income taxes, but you'll pay an additional 10% penalty on top of those taxes. For example, if you're in the 25% tax bracket and you pay the additional 10% penalty, that's 35%, or more than 1/3 taken out in taxes. That's insane. And the only time I would even consider doing this is if you really needed the money to pay off a debt that has an interest rate higher than 10% and you're about to lose your home or something serious like that. Outside of those dire circumstances, don't cash out. It's not free money, you're stealing from your own future. Okay, so back to IRAs. There are two kinds of IRAs, a traditional IRA and a Roth IRA. The traditional IRA is pre-tax, just like a 401k. So when rolling over 401k assets, put those into a traditional IRA. You can roll them into a Roth, but you'll have to pay income taxes on the balance. There is no limit to the amount of money you can roll over into an IRA from another tax-deferred account like a 401k, but you are limited by what you can contribute annually into the account going forward. As of right now, and the laws could change going forward, but you can currently contribute up to $5,500 a year into an IRA, which is enough if you gross $55,000 a year or less, because that equals 10%. If you earn more than $55,000 a year, we'll come back to that. However, just be aware of the limitations. Once you're in your 50s, you'll be allowed an additional $1,000 a year, or $6,500 total. The advantages of a traditional IRA are that being pre-tax allows you to deduct the contributions from your taxable income, thus affecting your net income less, just like a 401k. However, you are in the driver's seat regarding how your money is invested. You can invest your IRA in almost anything from stocks, bonds, mutual funds to gold, and even designate a savings account at your bank as an IRA if you want to go broke for some reason. What the IRA designation does is it allows you to deduct contributions from your gross income, avoid capital gains taxes while you're working, and have control over how the money is invested. The disadvantages of the traditional IRA include mainly that the money placed in the IRA cannot be touched until you're 59 and a half, unless you're willing to pay income taxes and an additional 10% penalty. There are limited exceptions, such as if you become disabled or other specific events. This means that even if your account does exceedingly well, and you could technically retire prior to age 59, you will have to wait unless you want to pay that 10% penalty. Another disadvantage is that once you begin taking distributions from your IRA, you will be paying income taxes on the money, not capital gains taxes, which are lower. This is because the money was tax deferred, meaning that although you avoided paying taxes on the contribution, you will be responsible for taxes on the distribution. So let's say you invested $20,000 over the life of the account, and it grew to be over $200,000. You successfully avoided paying taxes on the original $20,000, but you will now be responsible for paying taxes on the entire $200,000 over the course of your retirement. You must take distributions. You cannot avoid taking money out in order to avoid paying taxes. There's a schedule known as the Required Minimum Distribution, or RMD, that specifies what percentage you must take out as a minimum starting at age 70. If you fail to take the money out, you will get hit with a penalty, which ensures you'll pay even more money than if you simply took the money out like you were supposed to. It gets pretty confusing, but that's how it works when you play the tax game. The alternative to a traditional IRA is the Roth IRA. The only difference between the two is that the Roth is not tax deferred on the contribution side, but is tax-free on the distribution side. So again, let's say you invest $20,000 over the course of the account, and it grows to $200,000. With a Roth IRA, you cannot deduct the $20,000 from your taxable income when you invest it. So your net income will take a larger hit, but when you retire, the entire $200,000 is tax-free, and you never have to pay taxes on the money again, even on the interest. You also never have to worry about required minimum distributions because the IRS doesn't care as you're not paying taxes anyway. Now, there's nothing stopping Congress from changing the laws later and changing the rules on you, and I suspect that as Social Security and Medicare go bankrupt, they're going to become desperate and try to prop up the system somehow. So there's no guarantee this will stay the same. In fact, I would be very surprised if it did. However, that's one of those bridges we'll just have to cross when we get there. So knowing that our goal is 10%, how should we prioritize your contributions to maximize your benefits? The first priority should be the 401k with the employer match, but only up to the match. If the match is only 3%, then contribute to the 401k at 3%, and then open up an IRA for an additional 7% to equal 10% total. If the employer doesn't offer a match, go straight to the IRA. If you make too much money so that you hit the maximum contribution limit for the IRA and haven't hit 10% yet, we'll talk about variable annuities later. So as you can see, once you get above a certain income, or depending on whether you have a 401k match, you may have a remainder. Now, I chose the Roth IRA in this example because of the tax-free benefits, but you can easily substitute the traditional IRA if the tax-deferred benefit is more important now than the tax-free benefit is later. So let's say that you haven't hit your 10% yet, but you can't contribute any more to your IRA because you've hit the $5,500 limit. You can simply contribute to your 401k even if there's no match, or if you've already maximized the match. The downside is that again, you don't have full control over how it's invested. An alternative to this is to look into variable annuities. Now, be extremely careful with annuities, because there are actually several different kinds of annuities that do different things, and they're all called annuities. Annuities are insurance products that in some cases allow you to create your own pension, and were designed to be kind of like retirement insurance. The ones we're interested in are the ones called investment-only annuities. They don't have the fancy bells and whistles of funding your own pension or any of that, but they do allow you to invest your money tax-deferred just like an IRA because they are considered insurance products. And they don't have a maximum contribution limit. The downside of annuities is that there are fees associated with them, but if you get an investment-only style annuity and not the fancier ones, you'll minimize your fees. So, if you have a remainder after maximizing your 401k match and IRA, and you need something that provides tax benefits, and you're unimpressed with what your employer's 401k has to offer, look into variable annuities. But make sure you're only getting into the investment-only type strictly for the tax-deferred benefits, and not buying a pension-style annuity. When you talk to a representative about annuities, they will try to upsell you to one of the other types because they usually receive higher commissions. So don't let them talk you into buying more than you need. All you need is the tax deferral benefit. If the company you're used to working for doesn't offer that kind of annuity, shop around. They're out there, I promise. So now you've got your game plan, and you're contributing 10% of your gross income towards your retirement into something that offers you some form of tax benefit, so that it doesn't affect your net income, and thus your standard of living as much. If you can afford to eat the cost, then go ahead and go for the Roth over the traditional IRA. But if not, don't worry about it. You can mix and match between the Roth and the traditional IRAs, but you can only contribute a maximum of $5,500 a year in both combined. So now the literal $1,000,000 question is, what should I be investing all this money in? Well, we'll get to that in our next lesson. See you next time.